The stock market is really hot right now, and we keep seeing all-time highs every week for the Nasdaq and the S&P 500. Even the Russell, the small cap index, hit all-time high for the first time in about 5 years. But we all know that nothing lasts forever, and it's just a matter of time before we see a correction in the market. So how do you protect your portfolio? Most portfolios are at all-time highs right now. I know mine is at all-time high. So how do we protect our portfolios from a possible correction in the market? So in this video, we will talk about how we can hedge our portfolios to protect the gains that we've made in the market so far. Hi, my name is Ben. Welcome to Ben Talks Money. I have an MBA in Finance and Management, and I have been trading for the past 8 years. If you are new here, I would love to invite you to subscribe to the channel, like the video, share, and please help me grow this channel. So there are various ways that you can hedge your portfolio against a possible drawdown in the market, because this market is not going to keep going forever. The first is to buy stocks or ETFs with negative beta. So what is a beta? So a beta of a stock is basically how the stock moves relative to the entire market. So you can see stocks like your Apples and your Nvidias, they have betas close to 1 because they are not very volatile. And you have stocks like CoreWeaves and those very volatile stocks that they have a beta of 2 or 3, meaning that all things being equal, this stock will move 3 times the pace of the entire market, right? But there are some stocks that moves in the opposite direction of the market. That is what we call the negative beta. And most of these are actually the commodities, your gold, your silver, your copper. These metals tend to have a negative beta. Investors use them as a shield, right, to hedge their portfolios, because anytime the stock market is dropping, people will be fleeing to gold or to the other metals, but usually gold. So one of the best ways to hedge your portfolio is to buy gold. The ETF for gold is GLD. That is the best ETF for gold that you can get. It tracks the actual gold. There's nothing more in it, just gold. And this ETF has been going up drastically recently. I have GLD options in my account that is up about 40% right now. So it gives you the balance, right? That if there is a drop down in the market, this metals goes up. You know, gold always goes up when there's a drawdown in the market, right? The other way is to buy puts. Let's say you have SoFi stocks. Most of us do. I have SoFi stocks. I have SoFi options in some of my long-term accounts. So, and this stock is at all-time high. SoFi is trading above $30. It's the first time ever that this stock has hit $30. So in order to protect your investment, the gains that you've made so far, you can trim some of it, just sell a little bit to keep the profit just in case it drops. You can buy it back, or you can buy put options. If you don't know how to trade options, then the best way is to just sell a little bit of it and keep the cash in case it drops. Can always buy it back. If it keeps going, you have about 75% of your position still in there, right? So that is the other way, is buying options, put options. If you have ETFs, if you have a lot of ETFs in your account, the other way that you can hedge against any drop down is to buy the inverse of that ETF. If you look at the SPY, the SPY, which tracks the S&P 500, it has a number of inverse ETFs. So what this inverse ETF does is that if the SPY, the S&P 500 is going down, that will be going up, right? You can say those also have a negative beta because they go to the opposite direction of the entire market. So some of the inverse ETF for the S&P 500 is SH. There is another one called the SDS. There is another one called the SPXS. That is the short, right? So it's like the inverse form, the SPXS. Right, there is one called the SPXU. So those are the inverse of the SPY, the S&P 500 index. So if you hedge this, you might not have to buy a lot of it, just a few, so that you can at least recoup some of the gains that you get in case there is a drawdown in the market. Because again, at some point this market is going to correct itself, right? And if you have the Nasdaq, the QQQ, the inverse ETF for the QQQ is the SQQQ. If you have the QQQ in your portfolio, you can buy a little bit of the SQQQ to hedge, because when the Nasdaq goes down, that will go up, right? So those are a few ways that you can hedge your portfolio against a possible drawdown. And even if, let's say, if you buy all this, you might not buy enough, so when the stock market drops, you might still feel the heat, but it wouldn't be as severe as if you were just going in one direction, right? So that's the best way to keep holding. If you want to keep holding the stocks and the ETFs that you have, if you don't want to sell anything right now, because again, the market might drop 5-10%, but it will definitely bounce back. So if you want to get a little bit more money to buy more when the market drops, you can either sell a little bit of your position right now, you can hedge with the metals. I use gold. You can buy an inverse ETF, and helps you protect your portfolio. Okay, so that's it for the video today. 3 ways that you can hedge your portfolio against a drawdown in the market: buying options, put options, buying the metals, especially gold, buying the inverse ETFs. These will help you hedge your portfolio against any drop down. Right? So thank you so much for sticking around. If you are new, again, please like the video, share, subscribe to the channel. We have a lot of these kind of videos coming up, so don't miss out. It will help you grow and protect your portfolio. Okay, so until next time, let's keep talking money.